When it comes to the world of investment and stock analysts, incompetence is unfortunately a commonly recurring issue. But today's high-profile blooper stands out like a sore thumb. The stock analysts who covered Walgreens Boots Alliance, or WBA, have displayed a level of incompetence that is unprecedented. All of these analysts that we will show today have managed to miss the mark spectacularly. They've made lofty predictions that seemed promising at first, but crumbled under the weight of reality. Overestimations, misjudged market conditions, and a failure to adapt to shifting dynamics have led to a series of missed targets and misguided advice. Their blunders reveal not just errors in forecasting, but a deeper misalignment with the actual challenges and opportunities facing Walgreens Boots Alliance. The result? A textbook case of how professional oversight can lead investors astray and turn optimism into a cautionary tale. The investment world is a tumultuous place, a place where one thing can change and literally bankrupt you if you're not well informed and adaptable. Today, we will tear into the incompetence of WBA's chosen analysts, and we will give a background on the fundamentals of WBA. We will show how the writing was on the wall the entire time, and more importantly, we will provide 4 lessons you can start using today to ensure that you never fall prey to the incompetence that occurs on Wall Street. So stay tuned until the end. Be sure to like, subscribe, and hit the notifications icon so you are notified accordingly, and continue to tune in to Incompetent Capital, where accountability for competence on Wall Street is our #1 priority. On the WBA stock analysts we reviewed, most of them were guilty of the same analyst groupthink that we mentioned in our previous videos. As you can see on the chart, some made gutsy calls that were out of the norm, and for that, even though they were grossly incompetent and outright wrong, we award their courage and ability to do so, and they will get a pass today. But Charles Rhyree, Kevin Caliendo, Elizabeth Anderson, David Macdonald, and Ben Hendrix are incompetent analysts of the day, not only egregiously engaged in analyst groupthink, but as you can see on the chart, they all completely botched history with the calls they made on this stock. Charles Rhyree of TD Cowen overshot this stock essentially on every call he made except for one, from the peak all the way down. As you can see from the chart, Charles, from September of 2015, overshot the stock with a bold outperform at 104 and overbid all the way down to where he lowered to 22 while the stock itself sat at a paltry $11. Way to go, Charles, only overbidding the stock by 100% in its bitter low point. To his credit, he did start to aggressively lower in March of 2021 to 41 when the stock was at 46, which was a good call, but unfortunately, he quickly decided to drink the Kool-Aid again and raised his estimate to outperform at 53. Charles, what the hell happened? You were doing so well. Was Kevin pressuring you? Our next defendant in the incompetence court today is Kevin Caliendo of UBS. If you guys listen to what we teach later today in this video, you will be more equipped to not fall prey to the incompetence that is being shown by these analysts. But, unfortunately, if you had listened to Kevin on WBA, you would have bought high, sold way lower, and earned your way into the nearest homeless shelter. As you can see from the chart, in July of 2012, Kevin made a buy call at a whopping 94 when the stock was trading in the high 50s. That was a bold move, Kevin. Good for you. But unfortunately for him, his bold move was grossly incompetent as the stock only continued to move lower after this call. And Kevin decided to chase the stock all the way down while overbidding the entire way. To his credit, he did call the sell price spot on in March of 22, but there are 2 problems with this. 1, this was clearly a reactive call, and 2, he continued to overbid the stock after this again, essentially all the way down as it crashed. Absolutely egregious. But Kevin is not alone. Elizabeth Anderson from Evercore decided to join in on Kevin's overbidding party. Instead of going to work, they simply drank and overbid the stock while it proceeded to tank. As you can see, she joined Kevin's party a little later on in the game in January of 2022, but she got an aggressive head start overbidding at 55 when the stock was trading at 47. Doesn't sound as bad as Kevin's early call, right? Wrong. She did this in the midst of the crash. She ignored all of the clear fundamental signs that were screaming loud at this point. True, You can argue that there were some indicators that showed that the stock may bounce, but she obviously didn't buy into that theory because, as we can see on the chart, she was chasing the stock all the way down. Our next defendant in incompetence court today is David Macdonald of Truist. This guy is a good example of something that we have been noticing across the board on Wall Street. Not only does he chase the stock down in his estimates, but as he lowers, he maintains a hold call all the way down. The why of that is the subject for a later discussion, but let's just say for now that David is likely acting as a silent relationship manager with WBA. What is interesting also is that David not only followed the stock down, but also bid up on the bump in April of 2021, all the while not changing from a hold. David, don't be so obvious about it, man. Analyst or relationship manager. Pick one profession. You can't do both at the same time. There are conflicts of interest. Our final culprit of the day, Ben Hendrix of RBC, was another late joiner to the overbidding party. He isn't related to Jimi Hendrix, but as you can see from the chart, he was definitely sipping on the same Kool-Aid that our good old friend Jimmy used to sip on. Because there is no way any sober and competent human being in their right mind would join in that late only to make calls on a stock that was already trending downwards with clear fundamental indicators screaming over the last 2 to 3 years, only to overbid it the entire way down.
Disclaimer: Incompetent Capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on.
No analysis needed, the chart speaks for itself. So chasing the stock downwards, maintaining hold calls instead of sell calls, no public apologies, no admission of, I made years worth of horrible calls, and almost everyone covering this stock was guilty of this. WBA was suffering the entire time, and there were clear fundamental indicators that displayed this. Walgreens Boots Alliance, or WBA, is one of the largest pharmacy-led healthcare and well-being enterprises in the world. Formed in 2014 through the merger of Walgreens and Alliance Boots, the company has a global footprint operating in multiple countries with a business model centered around retail pharmacy chains, pharmaceutical wholesaling, and health services. Despite its expansive reach, WBA has faced significant challenges in recent years. Financially, the company has seen solid revenue streams due to its extensive retail network and strategic partnerships, but its income statement tells a different story. Rising competition and increasing operational costs have squeezed profit margins, and the company's substantial debt load reflected in its cash flow statement adds to the concerns. The COVID-19 pandemic further complicated WBA's situation. While the company did see an initial boost in sales due to increased demand for healthcare products and COVID-19 related services, the long-term impact was less than favorable. The pandemic accelerated the shift towards online shopping and home delivery, areas where WBA lagged behind its competitors. Additionally, operational disruptions caused by the pandemic, including supply chain issues and fluctuating store traffic, put further pressure on the company's profitability. Management changes during this period also added to the uncertainty. In 2021, WBA saw a significant leadership shift with the appointment of a new CEO, Roz Brewer, who was tasked with steering the company through these turbulent times. While Brewer brought fresh perspectives and initial strategic changes aimed at modernizing the business and expanding into healthcare services, these efforts are still in their early stages and have yet to fully materialize in improved financial performance. Although WBA has tried to innovate and expand its services, these efforts have not been enough to counter the declining profitability in its core business. The broader market conditions have only added to WBA's woes, with fierce competition from both traditional rivals and new players like Amazon, and internal challenges such as restructuring efforts, store closures, and leadership changes, creating a turbulent environment. From a technical analysis perspective, even though that isn't the analyst's focus, so they get a pass on this, but still worthy to mention, several indicators from mid-2018 to 2024 signaled the company's downturn. Starting in mid-2018, WBA's stock began to show a series of lower highs and lower lows, a classic sign of a bearish trend indicating weakening momentum. The relative strength index frequently dipped into oversold territory, a clear red flag for potential further declines. Moreover, the 50-day moving average consistently stayed below the 200-day moving average from 2019 onwards, forming what is known as a death cross, a strong indicator of an ongoing downtrend. Volume analysis during this period also revealed increasing selling pressure with concurrent frequent spikes in volume on down days, suggesting institutional investors were offloading their positions. These technical indicators, coupled with the deteriorating fundamentals, painted a clear picture of WBA's impending struggles, one that the analysts we discussed today definitely overlooked. The failures of these analysts offer several key takeaways for investors. First and foremost, it highlights the importance of critical analysis and due diligence. Relying solely on analyst predictions without conducting your own research can lead to disastrous outcomes. By thoroughly examining financial statements, understanding a company's performance, and looking beyond surface-level metrics, you can make more informed decisions. Additionally, understanding market conditions and being adaptable to changes are crucial. The market is constantly evolving, and what may seem like a strong investment today could turn sour if external factors shift. Lastly, it's essential to avoid relying on analyst predictions. Analysts, like everyone else, are fallible, and their assessments are sometimes driven by groupthink or even other external pressures. By incorporating your own critical thinking and maintaining a healthy skepticism, you can better navigate the complexities of investing and avoid the pitfalls that have tripped up even seasoned professionals. And if you fail to do this for yourself, then you just may wake up one day, turn on YouTube, and see your own face in the incompetence court on our channel. So please, do yourself a favor and do your own due diligence when making investment decisions. When it comes to the world of investment and stock analysts, incompetence is unfortunately a commonly recurring issue. But today's high-profile blooper stands out like a sore thumb. The stock analysts who covered WBA have displayed a level of incompetence that is unprecedented. All of these analysts we showed today have missed the mark spectacularly. They've made lofty predictions that seemed promising at first, but crumbled under the weight of reality. Overestimations, misjudged market conditions, and a failure to adapt to shifting dynamics. Feel free to check this video out for a deep dive on another recent blooper, that of Alibaba.